Imagine discovering the next big stock before the experts even notice it, just by paying attention to the world around you. That's the power Peter Lynch shares in One Up on Wall Street. He shows how everyday investors can turn simple observations into smart investments, proving that you don't need to work on Wall Street to beat it. Wall Street wants you to believe that investing is complicated, that you need sophisticated algorithms, expensive analysts, and insider connections to succeed. But here's the truth. Peter Lynch discovered managing the Fidelity Magellan Fund. Amateur investors actually have significant advantages over professionals. While fund managers are constrained by regulations, required to diversify across hundreds of stocks, and pressured to follow the herd, you're free to invest in what you know and understand. You can act on observations before Wall Street even notices. When you see a Dunkin' Donuts opening new locations in your neighborhood, or your kids can't stop talking about a new toy, or your company starts using innovative software that makes work easier, you're witnessing investment opportunities in real time. Professional analysts won't write reports on these trends for months or years. By the time mutual funds pile into these stocks, you could already be enjoying significant gains. Lynch calls this dumb money, but there's nothing dumb about it. It's informed observation applied to investing. You don't need a finance degree or complex models. You need curiosity, patience, and willingness to do basic research. The playing field isn't just level for individual investors. It's actually tilted in your favor if you use your everyday experiences wisely. Chapter 1. The making of a stock picker. Nobody is born knowing how to pick stocks. Peter Lynch certainly wasn't. He grew up in a family scarred by the Great Depression, where stocks were considered dangerous gambling. His father died when Lynch was young, leaving his mother to raise the family with limited means. Lynch worked as a caddy at an exclusive golf club where he overheard wealthy members discussing their investments, which sparked his curiosity. He realized these successful people weren't geniuses. They simply understood businesses and invested accordingly. Lynch bought his first stock, Flying Tiger Airlines, while in college. After researching the air freight industry, it quintupled, helping pay for his education at Wharton Business School. This early success taught him a crucial lesson. With research and patience, anyone can identify winning investments. After serving in the Army, Lynch joined Fidelity Investments as a research analyst, eventually becoming manager of the Magellan Fund in 1977. Under his leadership through 1990, Magellan became the world's best-performing mutual fund, growing from $80 million to $14 billion in assets, with an average annual return of 29%. But Lynch maintains his success wasn't due to superior intelligence or secret formulas. It came from applying common sense, doing thorough research, staying patient during volatility, and recognizing that investing is an art requiring judgment, not a science demanding complex mathematics. If he could learn it, so can you. Chapter 2. The Wall Street Oxymorons. Wall Street is filled with contradictions and paradoxes that Lynch calls oxymorons. Professional money managers have access to the best research, fastest computers, and direct lines to company executives, yet they consistently underperform the market averages. Why? Because they operate under crippling constraints. Institutional investors must follow strict diversification requirements, meaning they can't concentrate positions in their best ideas. They're evaluated quarterly, creating pressure for short-term results that leads to poor long-term decisions. They suffer from herd mentality, everyone buying the same popular stocks because it's safer to fail conventionally than succeed unconventionally. If a fund manager buys IBM and it drops, nobody questions the decision because everyone owns IBM. But if they buy an unknown company that fails, they risk their career. This creates perverse incentives toward mediocrity. Fund managers also can't invest in very small companies because their assets are too large. Buying meaningful positions would move the stock price dramatically. Individual investors face none of these constraints. You can invest your entire portfolio in 3 companies if you want. You can buy small stocks that institutions ignore. You can hold positions for decades without quarterly performance reviews. You can invest based on personal observation rather than consensus opinion. The supposed experts are actually handicapped by their professional status, while you enjoy complete freedom. Understanding these paradoxes reveals why the smart money often isn't that smart, and why your everyday observations can lead to better investment decisions than Wall Street's sophisticated research. Chapter 3. Is this gambling or what? Many people view the stock market as glorified gambling, essentially a casino where you're just as likely to lose everything as win big. Lynch acknowledges that stock investing does involve risk, but argues there's a fundamental difference between gambling and intelligent investing. In gambling, the odds are fixed against you. The house always has an edge, and over time you're guaranteed to lose. In investing, you can tilt the odds in your favor through research and patience. When you buy stock in a profitable company with strong fundamentals trading below its intrinsic value, you're not gambling. You're making a calculated decision with favorable odds. The key is treating stocks as ownership in businesses, not lottery tickets. Lynch emphasizes that even professional investors experience losses regularly. If 6 out of 10 of his stock picks perform as expected, he's grateful. 7 out of 10 is cause for celebration. You don't need to be right all the time. In fact, Lynch's biggest winners often came from unexpected sources. Stocks he almost didn't buy or held, despite initial poor performance. The difference between successful investors and gamblers is that investors cut losses when fundamentals deteriorate. Let winners run when businesses improve and constantly reassess their thesis based on new information. Gamblers chase losses, cash out winners too early, and make decisions based on emotion rather than analysis. Investing becomes gambling only when you buy stocks without research, ignore fundamentals, try to predict short-term price movements, or invest money you can't afford to lose. Chapter 4. Passing the Mirror Test. Before you invest a single dollar in stocks, Lynch insists you must honestly answer 3 personal questions while looking in the mirror. First, do you own a house? If not, buy a house before buying stocks. Real estate is a forced savings plan where you build equity through monthly payments. It's a tangible asset providing shelter while appreciating over time. Most people research houses thoroughly, visiting dozens before deciding, yet spend minutes choosing stocks. This backwards priority costs them dearly. Second, do you need this money? If you'll need funds within 2 or 3 years for college tuition, a wedding, or a down payment, stocks are inappropriate. Market volatility can devastate short-term investments. The money you invest in stocks should be truly surplus, funds you can afford to lose without affecting your lifestyle or goals. Lynch saw too many people forced to sell stocks at market bottoms because they needed money, turning temporary paper losses into permanent, real losses. Third, do you have the personal qualities necessary for stock market success? This requires patience to hold stocks for years, tolerance for uncertainty and volatility, and willingness to do research. If watching your portfolio drop 20% causes panic selling, you lack the temperament for stocks. If you trust gut feelings over facts, or can spend hours reading annual reports and industry analysis, you're not suited for individual stock picking. Be brutally honest. Failing the mirror test doesn't make you a failure. It makes you self-aware enough to choose appropriate investments like index funds or bonds. Chapter 5. Is this a good market? Please don't ask investors. Constantly ask Lynch whether now is a good time to invest, as if timing the market is possible. He responds bluntly. Nobody can consistently predict market movements. Not professional economists, not famous investors, not even Lynch himself. Every major market move surprised him during his career. Trying to time the market is futile because stocks and the economy don't move in predictable lockstep. Sometimes stocks rise during recessions and fall during economic expansions. The relationship is loose and unpredictable. Even if you could predict the economy perfectly, you still couldn't predict stock prices because markets reflect future expectations, not current conditions. By the time economic data confirms a recession, stocks have already adjusted. Lynch watched countless investors sit on the sidelines during the 1980s bull market because they were waiting for a crash. They missed life-changing gains, waiting for the perfect moment that never came. His advice is simple. Ignore the market entirely. Stop asking whether it's a good market. Instead, focus on finding good companies, trading at reasonable prices. There are always great companies somewhere, regardless of overall market conditions. When the market is high, find undervalued sectors. When the market crashes, find survivors with strong balance sheets. The market is irrelevant if you're buying quality businesses. Some of Lynch's best returns came from stocks purchased during the worst markets. He bought when others panicked, held through volatility, and enjoyed the recovery. Market timing is for fortune tellers. Stock picking is for patient research. Chapter 6. Stalking the 10-bagger. A 10-bagger is a stock that increases 10 times in value from your purchase price. Lynch built his career finding 10-baggers, and they're more common than you think. The key is recognizing them early, before Wall Street discovers them. 10-baggers usually come from small companies with room to grow, not established giants. A $3 billion company can grow to $30 billion. A $300 billion company can't grow to $3 trillion. Look for companies expanding into new markets, opening new locations, or introducing products with huge potential markets. Lynch found 10-baggers everywhere. Dunkin' Donuts expanding nationally, Walmart moving beyond Arkansas, Taco Bell going mainstream, Body Shop bringing ethical cosmetics to America. These weren't obscure companies requiring insider knowledge. Ordinary people encountered them daily, years before analysts wrote reports. The consumer has an edge over Wall Street because you experience products firsthand. When your teenager obsesses over a retailer, when your company adopts new software that dramatically improves efficiency, when your spouse discovers a restaurant chain and insists on eating there weekly, you're witnessing potential The challenge is distinguishing real opportunities from fads. Research is essential. A great product doesn't guarantee a great stock. You need to verify the business model. Check the balance sheet, confirm profitability, assess competition, and understand growth potential. But your personal observation provides the initial insight that directs your research toward promising candidates. Many investors waste time analyzing companies they'll never understand while ignoring obvious winners right in front of them. Chapter 7. I've got it. I've got it. What is it you've identified a promising company through personal experience? Now what? Don't rush to buy the stock. First, understand what you actually own. Can you explain the business in 2 minutes to a 12-year-old? If not, don't invest. Lynch passed on countless stocks because he couldn't articulate a clear investment thesis. Complex businesses create opportunities for things to go wrong that you won't understand until it's too late. Simplicity provides clarity and reduces risk. Next, determine whether this is a small company with massive growth potential or a large company with limited upside. This fundamentally affects your return expectations and holding period. A small regional retailer expanding nationally can become a 10-bagger. A large established company might return 15 to 20% annually, which is excellent but different from 10 times your money. Lynch categorizes stocks into 6 types: slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. Each requires different analysis and different strategies. Fast growers need confirmation that growth can continue. Stalwarts need reasonable valuations. Cyclicals need careful timing. Turnarounds need evidence of actual improvement. Understanding the category guides your research and sets appropriate expectations. Most importantly, know why you're investing. Write it down. I'm buying this stock because revenues are growing at 25% annually. They're expanding from 3 states to 15 states, and competition is limited because of their proprietary technology. This investment thesis becomes your roadmap. When the stock price drops, you refer back to your thesis. If nothing fundamental changed, you hold or buy more. If the thesis breaks, you sell regardless of price. Chapter 8. The perfect stock. What a deal. What makes a stock perfect? Surprisingly, it's not cutting-edge technology or exciting products. The perfect stock is boring. It has a dull name like Bob Evans Farms or Pep Boys. It doesn't attract attention at cocktail parties. It does something boring, disagreeable, or even disgusting that makes people say, "Ah," when you mention it. This could be funeral homes, waste management, or cleaning products. Wall Street analysts avoid boring companies because they're not exciting to write about, which means they stay undervalued longer. The perfect stock operates in a slow-growth industry, so competitors aren't attracted to enter. Fast-growing industries attract smart entrepreneurs and venture capital, creating fierce competition that erodes profits. Boring industries keep competitors away, allowing excellent companies to dominate quietly. It's better to be a great company in a bad industry than a bad company in a great industry. The perfect stock is misunderstood or overlooked by institutions. Maybe it's too small for large funds to buy, or it's located in an unfashionable region, or it operates in an industry analysts don't cover. This keeps the stock price depressed despite solid fundamentals. The perfect stock has a niche or monopoly in its market. It might be the dominant supplier of a specialized component, or the only provider of a necessary service in a geographic area. Customers depend on it, creating pricing power and sustainable profits. Finally, the perfect stock has insiders buying their own shares with personal money. When executives risk their wealth on their company, that's a powerful signal. They know things you don't, and their purchases suggest confidence in future prospects. Chapter 9. Stocks I'd avoid, just as there are characteristics of great stocks. There are warning signs of stocks to avoid completely. First, avoid the hottest stock in the hottest industry. Everyone's talking about it. It's getting tremendous media coverage, and social pressure makes you feel foolish for not owning it. This is exactly when you should run away. Hot industries attract competition that destroys profits. Hot stocks are priced for perfection, so any disappointment causes catastrophic drops. Lynch saw this repeatedly. Oil services in the early 80s, biotechnology in the late 80s, internet stocks in the late 90s. Fortunes were lost chasing heat. Second, avoid stocks labeled the next something, the next IBM, the next Microsoft, the next Amazon. Companies tagged this way almost never live up to expectations. Third, avoid diversifications. Companies that acquire businesses outside their expertise. When a successful chain restaurant buys a clothing retailer, destruction of shareholder value usually follows. Management thinks success in one industry transfers to another. Rely dose. Fourth, avoid whisper stocks. The supposed secret investments everyone's whispering about at parties. If thousands of people know the secret, it's already in the price. Fifth, avoid companies whose growth depends on one customer. If your biggest customer represents 50% of sales and they're struggling, you're doomed. Sixth, avoid stocks with exciting names in exciting industries, especially if they're barely profitable and trading at astronomical valuations. The excitement masks fundamental weakness. Finally, trust your observations. If a retailer is always empty when you visit, don't buy the stock, regardless of what analysts say. Chapter 10. Earnings. Earnings after you've identified a promising stock and avoided obvious traps. What actually determines whether the stock price rises? Lynch answers emphatically. Earnings. Stock prices ultimately follow earnings. Everything else, economic forecasts, market trends, political events, is noise. Companies with growing earnings see their stock prices rise over time. Companies with declining earnings see their stock prices fall. It's that simple. Wall Street can ignore this reality for months or even years, bidding up profitless companies based on narrative and speculation. But gravity always reasserts itself. Earnings determine value. This is why Lynch obsesses over company fundamentals rather than market conditions. He studies income statements, balance sheets, and cash flow statements to understand whether earnings are real and sustainable. Are revenues growing? Are profit margins expanding or contracting? Is the company generating cash or burning it? Are earnings coming from core operations or accounting gimmicks? Some companies report earnings using creative accounting that obscures reality. Lynch looks for companies with straightforward businesses, producing consistent, predictable earnings growth. He particularly loves companies that surprise Wall Street with better than expected earnings. When a company beats estimates, quarter after quarter, the stock often remains undervalued as analysts slowly adjust their models upward. This creates opportunity for patient investors. Conversely, when a company misses earnings repeatedly, trouble is brewing. Lynch sells immediately. When the earnings story deteriorates, don't fall in love with stocks. You're not married to them. When earnings disappoint and the fundamental thesis breaks, admit the mistake and move on. Protect your capital for better opportunities. Remember, earnings. Chapter 11. The 2-minute drill. Before investing in any stock, you should be able to explain your investment thesis in 2 minutes. This forces clarity and reveals whether you truly understand what you're buying. Lynch developed this drill from his experience attending hundreds of company presentations. Management teams would spend an hour with elaborate slides and complex charts. Yet he couldn't articulate why he should buy the stock. That was a red flag. If you can't explain it simply, You don't understand it well enough to risk your money. Your 2-minute thesis should cover several key points. First, what does the company do? Describe the business model in plain English. If you need jargon or complicated explanations, reconsider the investment. Second, what's your investment thesis? Why will this company's stock price rise? Are they entering new markets, launching new products, gaining market share, improving margins, turning around operations? Be specific. It's a good company isn't a thesis. Third, what's the expected return and time frame? Are you seeking a quick 20% gain or a long-term 10-bagger? Different goals require different strategies and patience levels. Fourth, what could go wrong? Every investment has risks. Articulate them honestly. Is the company dependent on one customer, facing new competition, operating in a cyclical industry? Acknowledging risks doesn't mean avoiding the stock. It means understanding what you're accepting. Finally, what would make you sell? Set clear criteria in advance. Maybe it's a specific price target, or deteriorating fundamentals, or changes in industry dynamics. Without predetermined sell criteria, you'll make emotional decisions during volatility. Practice your 2-minute drill on paper before investing $1. If you can't articulate the thesis clearly, keep researching until you can. Chapter 12. Getting the facts. Personal observation identifies investment candidates, but you need facts to validate your thesis. Where do you find these facts? Start with the company itself. Request an annual report, which by law must provide financial statements, management discussion, business descriptions, and risk factors. Annual reports contain everything you need to evaluate a company. Lynch particularly focuses on several numbers in the financial statements. The price-to-earnings ratio compares stock price to annual earnings per share. A pay of 15 means you're paying 15 times annual earnings for the stock. Compare this to the company's historical pay, competitors' payees, and the market average. A low pay might indicate a bargain or fundamental problems. A high pay might reflect justified growth expectations or dangerous speculation. Context matters. The debt-to-equity ratio reveals financial health. Too much debt is dangerous, especially for cyclicals or turnarounds where cash flow can disappear during downturns. But some debt is fine for stable companies. What matters is whether the company can service its debt comfortably from operating cash flow. Free cash flow, the cash a company generates after capital expenditures, tells you if earnings are real. Some companies report accounting profits while burning cash, often due to aggressive revenue recognition or inadequate reserves. Positive and growing free cash flow is a strong signal. Also, check insider ownership and recent trading. Are executives buying or selling their shares? Significant buying suggests confidence. Heavy selling raises questions. Finally, read what competitors and industry analysts say about market dynamics. Never invest based on a single data point. Gather comprehensive facts, then make informed judgments. Chapter 13. Some famous numbers beyond the basics. Lynch relies on several key metrics that reveal a stock's value and prospects. The PEG ratio, price earnings to growth rate, compares the pay ratio to expected earnings growth rate. A PEG of 1 is fair value. A stock trading at a P of 15 with 15% expected growth has a PEG of 1. Below 1 suggests undervaluation. Above 2 suggests over. This helps you avoid paying excessive prices for growth. Book value, the accounting value of assets minus liabilities, divided by shares outstanding, matters most for asset plays and financial companies. A stock trading below book value might be a bargain, assuming the assets are real and properly valued. However, book value is irrelevant for service companies or those whose value comes from intangibles like brand and talent. The dividend yield and payout ratio reveal financial strength and management priorities. A healthy dividend suggests confidence in sustainable cash flow. A rising dividend over many years is an excellent sign. But watch the payout ratio, the percentage of earnings paid as dividends. Above 80% leaves little room for maintaining dividends if earnings dip. Inventory turnover and same-store sales matter for retailers. Inventory building faster than sales growth suggests trouble. Merchandise isn't selling, leading to markdowns that hurt margins. Same-store sales show whether growth comes from new locations or genuine customer demand. For cyclicals, watch capacity utilization and pricing power. When industry capacity hits 85%, Pricing strengthens and profits surge. When capacity is abundant, competition intensifies and profits collapse. Understanding these numbers doesn't require an MBA, just willingness to read and calculate. Knowledge is your competitive advantage. Chapter 14. Rechecking the story. Buying a stock isn't the end of your research. It's the beginning of an ongoing monitoring process. Companies change, industries evolve, and your original investment thesis might break. Lynch constantly rechecked his holdings, asking whether the reasons he bought the stock still applied. For fast growers, has growth slowed? This is the most important question. Fast growers command premium valuations because of their growth. When growth decelerates, valuations collapse. Watch for saturation in their primary market, increasing competition, or management execution problems. If growth is ending, sell immediately, regardless of overall market conditions. For stalwarts, are they gaining or losing market share? Stable companies should maintain their competitive position. If they're being displaced by rivals or changing consumer preferences, trouble is brewing. Watch for declining same-store sales, margin compression, or market share losses to competitors. For cyclicals, where are we in the cycle? Cyclicals rise and fall with economic cycles and commodity prices. The time to buy is when things look terrible and everyone's pessimistic. The time to sell is when capacity is tight, prices are high, and everyone's optimistic about continued strength. Don't make the mistake of buying cyclicals at peak prices because near-term earnings look great. For turnarounds, is the turnaround actually happening? Many attempted turnarounds fail. Watch for concrete evidence. Cost reductions taking hold, debt declining, unprofitable divisions closed, margins improving. Without tangible progress, hopes for turnaround are fantasies. Sell turnarounds after they've turned around, when everyone agrees the problems are solved. That's when the easy money is made. Chapter 15. The final checklist. Before pulling the trigger on any stock purchase, run through Lynch's comprehensive checklist to avoid stupid mistakes. First, confirm you understand the business. Can you explain what the company does to a child? If not, pass. Second, verify the reason you're buying. Is it a fast grower with room to expand? A stalwart at a reasonable price? A cyclical at the bottom? Each category requires different criteria. Third, check whether the company has advantages over competitors. Patents, brands, cost structure, distribution, network effects, anything that creates a moat, protecting profits. Without competitive advantages, profits will be competed away. Fourth, examine insider ownership in buying. Do executives own significant stakes? Are they buying more with their own money? Insider buying is bullish. Insider selling is bearish, though less dramatically so, since executives sell for many reasons. Fifth, assess the company's growth potential. Is the product or service in high demand? Is the addressable market large? Can they expand geographically or introduce new products? Or are they nearing saturation with limited growth ahead? Sixth, confirm financial strength. Look at debt levels, cash flow, and liquidity. Companies with strong balance sheets survive downturns and fund growth without diluting shareholders. Weak balance sheets create permanent capital losses when things go wrong. Seventh, determine your expected return and holding period. What needs to happen for you to double your money? Is that realistic? How long will it take? Without specific targets, you'll either sell too early or hold too long. Eighth, identify what would make you sell. Set criteria now so emotions don't drive decisions later. Chapter 16. Designing a portfolio. How many stocks should you own? Wall Street says diversification requires owning dozens of stocks across many sectors to reduce risk. Lynch disagrees. For individual investors, owning too many stocks creates complexity you can't manage. He suggests a concentrated portfolio of stocks you understand deeply, maybe 5 to 15 positions for most people. This allows you to monitor each company closely and have conviction during volatility. However, don't go to extremes. Owning 1 or 2 stocks exposes you to company-specific disasters that could wipe you out. Some diversification is essential, but you don't need 50 stocks. Diversify across stock categories. Own some stalwarts for stability, some fast growers for explosive returns, maybe a cyclical if you can time the cycle, perhaps a turnaround if you're confident in the thesis. This creates balance where different holdings perform well under different conditions. But don't force diversification by buying stocks outside your knowledge. Better to own 6 great companies you understand than 20 mediocre companies. Don't. Lynch also suggests diversifying over time through dollar-cost averaging. Rather than investing all your money immediately, spread purchases over months or years. This reduces risk of buying at market peaks and takes emotion out of timing. When stocks drop, your regular purchases buy more shares. When stocks rise, you're already invested. Over time, this averages your purchase price. Finally, keep some cash for opportunities. Not 50%, but maybe 10 to 20%. When market panics create bargains, having cash lets you capitalize. Just don't obsess over cash levels. Being fully invested in great companies beats holding cash waiting for crashes that might not come for years. Chapter 17. The best time to buy and sell. Investors obsess over timing. When exactly should I buy or sell? Lynch's answer: focus on the company, not the calendar. The best time to buy is when you've found a great company at a reasonable price and you have conviction in your thesis. The best time to sell is when the investment thesis breaks, the stock becomes overvalued, or you've found something better. That's it. Ignore market predictions and economic forecasts. However, Lynch offers guidelines for different stock categories. For fast growers, buy when growth's accelerating and the market hasn't recognized it yet. Sell when growth slows or the market becomes overly optimistic, pricing in years of future growth. Don't wait for growth to completely die. Sell when deceleration begins. For stalwarts, buy when they're out of favor and the pay is below historical averages. Sell when they're popular and the pay is above historical averages. These stocks trade in ranges. Buy low, sell high. Repeat. For cyclicals, buy when business is terrible, the economy is in recession, and everyone is pessimistic. Sell when business is booming, capacity is tight, and everyone is euphoric. This contrarian timing is crucial for cyclicals, because their earnings fluctuate wildly. For turnarounds, buy when you see concrete evidence of improvement, but Wall Street remains skeptical. Sell when the turnaround is complete and everyone agrees the company is fixed. Don't wait for perfection to buy or deterioration to sell. In general, Lynch holds stocks much longer than most investors. His average holding period was several years. He believes if you don't have patience to hold a stock for 3 years, you shouldn't buy it. Chapter 18. The 12th silliest and most dangerous things people say about stock prices. Investors rationalize poor decisions with comforting platitudes that sound reasonable but are completely wrong. Lynch lists the most damaging. First, if it's gone down this much already, it can't go much lower. Wrong. A stock that's fallen from $40 to $8 can absolutely fall to zero. Prior declines don't create a floor. Second, you can always tell when a stock hits bottom. Nobody can reliably identify bottoms. Don't try. Third, if it's gone up this much, how can it possibly go higher? Some of Lynch's best returns came from stocks that had already tripled before he bought them. Great companies continue rising for years or decades. Fourth, it's only $3 a share. What can I lose? You can lose everything. Whether a stock costs $3 or $300 per share is irrelevant. What matters is the market capitalization and fundamentals. Fifth, eventually they always come back. No, they don't. Dozens of Lynch's stocks went to zero. Companies fail permanently. Sixth, it's always darkest before the dawn. Sometimes it gets darker. Don't buy based on average. Seventh, when it gets back to $10, I'll sell. The stock doesn't know or care what you paid. Your purchase price is irrelevant to future returns. Eighth, what me worry. Conservative stocks don't fluctuate much. All stocks fluctuate. Conservative doesn't mean stable. Ninth, it's taking too long for anything to happen. Great investments often take years to play out. Patience is essential. 10th, look at all the money I've lost. I didn't buy it. Opportunity cost isn't the same as losing money. These phrases reveal psychological biases that destroy wealth. Chapter 19. Options, futures, and shorts. Lynch devotes a chapter to investment vehicles he thinks individual investors should avoid. Options, futures, and short selling. Options are derivatives, giving you the right to buy or sell a stock at a specific price before a specific date. They're appealing because they offer leverage. Small investments controlling large positions, but they're time-sensitive and complex. Most options expire, worthless. Unless you have sophisticated knowledge of volatility, time decay, and probability, you'll lose money. Even professionals struggle with options. Futures contracts obligate you to buy or sell commodities or financial instruments at future dates. They offer even more leverage than options, meaning even faster losses. Lynch saw countless investors destroyed by futures, thinking they understood corn or gold or treasury bonds, but lacking the expertise to compete with full-time traders. Short selling means borrowing shares and selling them, hoping to buy them back cheaper and pocket the difference. It sounds simple but is incredibly dangerous. Your maximum gain is 100% if the stock goes to zero, but your losses are unlimited if the stock rises. Lynch occasionally shorted stocks in Magellan, but only after exhaustive research and with strict limits. Most short sellers get crushed. For individual investors, Lynch's advice is simple. Avoid all three. Focus on buying stocks in good companies and holding them patiently. That's hard enough without adding complexity. Options, futures, and shorts don't improve your odds. They dramatically worsen them while creating tax complications and stress. If you want leverage, use margin modestly. If you want to hedge, diversify your portfolio or reduce position sizes. Keep it simply. Chapter 20. 50,000 Frenchmen can be wrong in investing. Following the crowd usually leads to losses. Lynch titled this chapter after the French army's Maginot Line, an expensive fortification that proved useless when Germany invaded through Belgium. Everyone thought it was brilliant until it failed spectacularly. The same happens in markets constantly. During the 1980s, everyone knew Japan would dominate the world economy. Japanese stocks traded at extreme valuations. Then Japan entered a decades-long bear market. In the late 90s, everyone knew the internet changed everything, and old economy stocks were dead. Then the dot-com bubble burst, destroying trillions in wealth. Repeatedly, throughout history, consensus opinion proves spectacularly wrong at extremes. Why? Because when everyone agrees, they're all already invested. There's nobody left to buy, so prices can only fall. Conversely, when everyone is pessimistic and avoiding an asset class, the only direction is up once conditions improve. Lynch developed the cocktail party theory to gauge sentiment. Early in a bull market, when you mention you invest in stocks, people change subjects. They're not interested. That's a good time to be fully invested. As the market rises, people become curious and ask what you're buying. That's okay. The bull market continues. Late in the bull market, people brag about their stock gains and give you tips. This is dangerous territory. The end is near. At the absolute peak, strangers tell you which stocks to buy and quit their jobs to day trade. That's when you should sell everything and wait. Lynch doesn't advocate market timing, but understanding sentiment helps avoid the worst mistakes. When everyone's euphoric, be careful. When everyone's terrified, be greedy. Epilogue. Diary of a long-term winner. Lynch concludes with a personal story illustrating his investment philosophy. In October 1987, the stock market crashed, the Dow Jones falling 23% in a single day. Lynch was managing billions in the Magellan Fund, which lost 18% that day. Hundreds of millions in paper losses. Clients panicked, demanding he sell everything and go to cash. The media predicted economic depression. It felt like the world was ending. Lynch did the opposite. He looked at his holdings, companies with strong businesses, solid balance sheets, growing earnings, and competitive advantages. Nothing fundamental had changed. These companies were worth more than their new stock prices suggested. Rather than selling, he bought more of his best ideas. It felt uncomfortable, even frightening, but his analysis said it was right. 6 months later, the market had recovered fully. A year later, it reached new highs. Magellan had one of its best years ever. Clients who panicked and sold at the bottom never recovered their losses. Those who stayed invested prospered. This experience encapsulates everything Lynch teaches. Stick with quality companies. Do your research so you have conviction during volatility. Ignore market predictions and focus on fundamentals. Be patient and think long-term. Use market panics as buying opportunities, not reasons to sell. Trust your analysis over your emotions. Accept that stocks fluctuate, sometimes violently, but great companies ultimately prevail. Lynch's philosophy isn't complicated. Invest in what you know. Do your homework. Stay patient, and let compound growth work its magic over years and decades. It worked spectacularly for him, and it can work for you too. If you found value in this summary, hit the like button, subscribe for more insights, and share it with someone who could benefit from these life-changing principles.